contract for services with what we like to call Big Fidelity, the large organization with which many of you may be familiar. They're in the retirement plan, investment management, custodial, registered investment advisory business. Big Fidelity does a lot of things, but Fidelity Charitable is a wholly separate organization with a service contract arrangement. I always like to say that. And what that, of course, means is, as you'll see through the presentation, any gifts or transfers of assets to Fidelity Charitable becomes a completed and tax-deductible charitable gift, irrespective of grants to not-for-profits downstream that Tobi will be addressing in a little bit. So that's what we're doing. But I'm just going to plunge in. I'm going to talk a little bit about philanthropy in general and the kind of charitable accounts people use, and then a conversation about some current tax ideas and sort of what's going on here at Fidelity Charitable. And then we're going to talk some more about family and family giving and conversations Tobi will address. I love starting off with this slide. So what we're looking at here is the dollar amount that Americans give to charity annually. So Americans are just fantastically generous as a group. We don't have the 2020 tax returns in yet, and they're going to be a month later than usual. But for 2019, Americans gave almost $450 billion to charity. That came in right around about 2.1% of GDP, 2.1% of the total economy in the US. That is a phenomenal figure, but that turns out to be about the average year after year after year. For as long as records have been kept, Americans have given roughly 2% of GDP to charity. Good years, good equity market, good economy years, you'll get around 2.1, 2.2. Recession years, you'll get around 1.6, 1.7. As a group, Americans average about 2% a year of GDP to support their favorite organizations. For some context, the next two countries on the list are the Canadians and the New Zealanders. Canadians in particular, Americans in disguise, they all live within 20 miles of the border. And the Canadians come in right around 0.7% of GDP. So as a piece of the economy, philanthropy in the next country on the list is 2/3 smaller. Americans are really outliers in the scale of their philanthropy. And I have to say, Western Michigan, in my part of the world, is particularly great. Another interesting stat we always like to point at in the philanthropy in general is we get a lot of press, a lot of coverage around the big foundations, the Gates Foundation, the Ford Foundation, corporate giving. We get a lot of chatter around the big famous names, but the answer is, of this $450 billion, just shy of $300 billion of it was individuals making gifts to support organizations that are important to them. Their churches, their food bank, their pet rescue, their alma mater, all of the things that are important for people to support. The vast majority of this giving in America is individuals writing checks to support these great organizations. So Americans as a group are just fantastic. In the planning arena, where our friends at Grand Wealth live and where we work here at Fidelity Charitable, and a lot of families really try to get their charitable giving integrated into a larger, either into their current financial plans, their retirement planning, or in their longer term family wealth strategies. And in most planning contexts, we're going to have some sort of charitable account, or the industry term, some sort of charitable vehicle to facilitate the planning process. For today's quick conversation, I'm going to skip over the giving and generating income parts, and I'm going to focus on what we call giving while living, but the vehicles or the charitable planning tools that our clients use, or many of our clients use, to focus on moving funds from their current accounts out to their favorite charities, right? Giving while living. And in this context, that's going to be private foundations, with which many of you might be familiar, or donor advised funds, which many of you might be familiar. But those are the main vehicles. And I love these slides because they're graphic, and I am certainly a graphic learner. I like this. So the donor advised fund, that's what we do here at Fidelity Charitable. An individual is going to make a tax deductible donation to a donor advised fund. And then the donor advised fund, on advice from the donor, is going to make is going to request distribution. The donor advised fund is going to make grants to multiple charities downstream. So the donor advised fund, it's an account with a larger public charity for the purpose of making grants to charities in the future. Generally simple, low cost. There's an opportunity for tax-free growth. We'll come back to that in a minute. And the flexibility to support their favorite charities currently or off into the future. Over the last few years, there's been some really exponential growth in the donor advised fund space. And I think now we're at the end of 2021, when the numbers come out, we'll be approaching, as a nation, about 1 million donor advised funds out in use. The private foundation, you'll notice the graphic is identical. The individual is going to make a tax deductible donation to an organization, private foundation, and that organization, in conjunction with its board of directors, is going to make grants off to future charities. The main difference is right here in the blue square, or in the blue ovals. With, as you saw with the donor advised fund, the donor advised fund sponsor is a public charity like Fidelity Charitable or the Grand Rapids Community Foundation, or any sort of large public charity that has a system for donor advised funds. The private foundation, on the other hand, is an individual entity created generally by a family for the purpose of making this system work. So rather than have an account at a large charity in the context of a program, a private foundation, the family's going to build it themselves. Generally, these are for families that are quite interested in really rolling up their sleeves and get involved in their philanthropy, reading grant requests, making the individual grants, et cetera, and they're not intimidated by having to do the investment management, file the accounting, and take all the responsibility for due diligence on charities. Great reasons to have both. Many of our families here at Fidelity Charitable run both a private foundation as well as a donor advised fund, and many families find that the DAF is most appropriate. It's always about the family, their donor, and the donor intent for how and when they want to support their favorite charities. Those are the main discussions. With a donor advised fund, which is really what we do mostly here, what we do at Fidelity Charitable, we'll go back through it. The opportunity to make a tax deductible charitable contribution, very simple record keeping, just an annual account statement, quarterly account statements, I guess. A single donation makes it simple for your tax return, one receipt. I just got an email from an advisor whose client made 40 separate charitable gifts last year and called in looking for some other idea. Maybe one receipt and then gifts to 40 organizations through their donor advised fund. Much simpler record keeping. While funds are in the donor advised fund, there's a collection of investment choices, and for the assets to grow tax-free while they're waiting to be granted out, and then recommending grants out to IRS qualified public charities. I think year to date or trailing, as Anastasia mentioned in the introduction, here at Fidelity Charitable, we've made grants to over 300,000 different charities in the US, For context, I believe there's more than 1.5 million different charities in the United States. So there's plenty we haven't seen yet, but we're working on it. So that's how the donor advised fund system works, to make a single tax deductible gift as appropriate for your individual tax and portfolio planning, grow the assets, grow the funds while they're waiting to get granted out, and then subsequent gifts to the great organizations that people want to support. In that context of making the contributions, we necessarily are talking about portfolio, tax return, and the intersection of those two to maximize your opportunity to get the best benefit both for your organizations and for your tax return. So I want to cover just a couple of quick tax strategies we're thinking about these days at Fidelity Charitable. The key one is what we call bunching. And it has to do with the changes in the tax code in the 2017 Tax Cuts and Jobs Act, in which there were a couple of changes that took place in 2017. And for those of you that are taxpayers, you're getting a reminder of that in the next few weeks because you're going to get your tax return back from your accountant. But one of the things that happened in 2017 is the standard deduction system, which used to be exemptions and standard deductions, and you stacked them up, and the number of people in your household and all this stuff. That was quite simplified to standard deduction. And for a married couple under 65 filing jointly for 2020, their standard deduction is $25,000. And then the second thing that happened in the Tax Cuts and Jobs Act was that state and local taxes, our acronym is SALT, state and local taxes, those are tax deductible Schedule A items, but we were limited on that deduction to $10,000. So depending on your property taxes or state income taxes, or, I live in Ohio, I have city income taxes, whatever all that added up to, it doesn't matter. You were capped, you could only deduct $10,000. So here's our model charitable family. They're capped at $10,000 for state and local. In this example, they have $6,000 of mortgage interest over the course of the year, and they're super generous, and they make $10,000 of charitable gifts over the course of the year. This is a married couple. You add all that up, and it's just a little more than $25,000. It's about $26,000, right? So they're ahead of the standard deduction by $900. So they're going to itemize on their tax return. They're not going to take the standard, but in effect, their $10,000 of charitable donation results in a tax deduction of $900. So off of their federal taxes, they save $300, even though they're quite generous on their tax return. So this is the thing that happened to most people in the Tax Cuts and Jobs Act in 2017. So the great advice from charitable planners and from financial planners has been, if you are going to make the same charitable gifts year after year, which is what most people do here at Fidelity Charitable, right around 75% of our annual distributions to charities are repeat and scheduled gifts suggested by our donors over and over and over again. So most people make the same gifts year after year. The club will have at their alma mater, quarterly to their church, etc., and they add them up. If you're going to do the same gifts in this example for the ensuing 3 years, in the current scenario, you save a little less than $1,000 in taxes. But if you were to make all 3 of those years in the same year, and so rather than $10,000 spread over 3 years, a $30,000 charitable gift this year, then you're significantly ahead of your standard deduction by $20,000 for a much more satisfying tax savings in your charitable giving. So this is what we mean by bunching, and it has to do with looking into the future for charitable gifts and maybe pulling them back into a single year for a much more satisfactory tax benefit based on the same amount of gifts to your favorite charities. And then if you were to use a donor advised fund for this gift, then you would distribute the $10,000 a year over the ensuing years to your favorite charities. It's one way to think about it. So that's one thing that we're talking about, particularly right now, as people are reminded that you made charitable gifts last year, and take a look at your Schedule A as you get your tax back from your accountant and see how that's working. The second thing that we wanted to talk about, just to quickly address, it's quite similar, but in the event, some people, their income is choppy, or, because they have a transaction base, maybe in the real estate business or something, or it may be in the year in which you're retiring, so it's your last year on company payroll. But we look at maybe front loading, just like the bunching, front loading a future of philanthropy into a significant tax bracket change, right? So here's our normal donor, Fidelity Charitable. For an example, everybody gives $10,000 a year to charity. So that's the way we can do the math in our heads. So here's our donor who's going to give $10,000 a year for the next 10 years, but happens to be having a particularly high income year this year, pushing him into the top federal bracket. And then in this example, retiring, and so in a lower tax bracket in the future, just so we can do the math. And you can see what happens over the decade. Give away a great charitable stream of $10,000 a year or $100,000 over a decade, resulting in $25,000 of tax savings. If you were to make a single much larger gift, front loading this decade of charitable giving into a single year, when your tax bracket is at its highest, there's a considerably larger tax savings. And then, of course, were you to be using a vehicle like a foundation or a donor advised fund, then the $10,000 would be invested in the meantime and potentially give away even more. So there's a conversation to be had with your financial advisor and your portfolio about your future in philanthropy and how you might maximize your benefits both for your portfolio and for your tax returns. So that's a key thing that we're talking about this time of year. In conjunction with that, we always like to remind people of the power of using appreciated securities out of your portfolio rather than using cash to fund this charitable giving, particularly if we're going to ask you to make a significant contribution in a single year rather than doling it out over a collection of years. So here's our example. Our sample client, she happens to be in the top tax bracket. And as a story, the church has called and they have wind damage and they've asked for a $50,000 contribution. So in this example, our good client, our good donor is going to look into her portfolio and realize that she has a $50,000 position. It's a quite successful position, so most of it is unrealized gains. She bought the stock for $20,000 a while back. Now it's worth $50,000 and is subject to capital gains tax if sold. So what most people do is they look at this position and they will turn it into grantable form, i.e. cash, sell the stock. That's going to trigger the capital gains, and then write a check to the church and take a tax deduction. This is a great scenario. People like it. You take this $50,000 position, capital gains taxes are much lower than income taxes, but the net charitable contribution, $42,000 for a really nice $15,000 tax savings. But the alternative is considerably better. Let's imagine that our donor instead recognized the power of appreciated securities and transferred those shares directly to the charity. Now the charity sells the stocks. The charity pays the taxes on the gain at the charity's rate, which they're not for profit, so it's zero. So the charity doesn't pay any taxes. They sell the shares. Now the client takes a $50,000 tax deduction and the charity has $7,000 more in their bank account. And the client saves more on their tax return. So optimally, if there's appreciated securities anywhere around, this is the place to look for funding current and future charitable gifts, because feds at Uncle Sam's level give us free money to make it happen. It's a great system. So that's what we like about donating appreciated securities, particularly if you're doing some planning that has you front loading 2, 3, 4, 5, 10 years of a future in philanthropy. I want to pivot a little bit and talk about what's going on around here at Fidelity Charitable. We're the largest granting charity in the country, so it's using the Fidelity Charitable's statistics are a pretty good example of what's going on around the country. One of the things is in 2020, our little corner of philanthropy as a donor advised fund sponsor, our donors stepped up to the plate. 2020 was a tough year. We had, social unrest. We had a monstrous health problem. We had a recession. We had a lot of things went down in 2020. Our donors, or we at the advice of our donors, gave away more than $9 billion last year to roughly 170,000 different charities. It was a fantastic record year for us for distributions. You go back to our earlier slide, Americans are fantastically generous. 2020 was a tough year all around, and they were more generous than ever. It was just a great year around for philanthropy. I suspect Tobi will address that with some of the work that she's been doing as well. The other thing I wanted to address, the last couple of years have been pretty good for investment markets. There was a short market activity in the first part of 2020, as we all learned the news, but subsequently went on to do great. In our system, in the donor advised fund, as I mentioned earlier, the gifts get made in, then the funds get invested in the meantime, and then grants go out. So essentially the donor advised fund system serves as a bucket or as a side account to fund philanthropy. It's been pretty good for the last few years in equity markets. So over the history of our firm, we have accumulated and subsequently granted an extra $15 billion out to support charities just on investment earnings. So it's just been a great system for donors to grow and then give later. Here's an interesting document or slide from our 2020 report. What you're looking at here is 2019, and it's the sector of the most popular not-for-profit by each state. You can just sort of see how the US is quite diversified. In some states, the biggest not-for-profits are healthcare. In some states, it's human services, which includes food banks and daycare and that sort of thing. In many states, it's church organizations, religious organizations, educational. What you can see, and we see this in granting at Fidelity Charitable over the years, is when something big goes on, you can see the change in giving of what people do. So in 2020, across the nation, human services were the #1 charities in most states. Really a big change in giving as Americans stepped up to the plate. I live in Ohio, here in the Midwest where most of us live. I think the stats for the Midwest is gifts to food banks were up by 7,000% or some crazy percentage number of human services gifts in Ohio, Indiana, and Michigan, our sort of Midwestern territory. So really big changes as people have stepped up as donors to support current needs. It's fun to see the way that operates. Here at Fidelity Charitable, most of our gifts are in appreciated securities. We saw how the math makes sense, and it should come as not too much of a surprise. Many of Fidelity Charitable donors have some other affiliation with Fidelity. They probably have an investment account, so that's where we get a considerable amount of our contributions. I just wanted to quickly highlight down here a significant amount of the contributions into Fidelity Charitable are non-publicly traded assets, gifts of closely held securities. Many of those are in the context of the sale of a family business or a consulting business of some sort. So just because they're not, it's not Apple shares or Tesla shares or GM shares, there still might be an opportunity for a charitable contribution. And it was a lot, contributions last year, a little over $1 billion came in last year in that sort of contribution. So what you see in the Fidelity Charitable and the Donor Advised Fund story is a way to integrate your charitable planning with your financial planning, as well as have what I would call a charitable war chest in the event that something big goes on, like we saw in 2020, where granting really spiked out of Fidelity Charitable. And we'll see as the reporting comes in from our peers that granting really spiked across the country. I know one stat that didn't come up on my slides is our average donor here at Fidelity Charitable historically has supported about 10 charities on average. In 2020, it was well over 12 charities on average. So not only did our donors really step up on the dollar figures of grants, but actually stepped up to more charities. So it was really just a great story about America in general and our clients in particular for 2020. So that's my story on sort of the planning tools and the interest in the Donor Advised Fund. The other side of giving that we do here at Fidelity Charitable is our ecosystem of donor support, of supporting the families and the planning, not in their financial planning, but in their philanthropic mission and what it is that we're up to. And I've asked to join us my partner, Tobi Becerra, who works with our families to talk about sort of what it is they're trying to accomplish with their philanthropy, how that integrates into their family goals and whatnot. And so I'm going to just hand it off to Tobi to talk about what she does and give it away. I'll control the slides so you can tell me, Tobi, when to switch.
Okay. Perfect. Thank you, Jim. It's really great to be here. Thank you all for having us. I am a director of philanthropic strategies for our private donor group, which is a group that is comprised of our most generous donors. We guide them in their philanthropy and help to make sure that their philanthropic goals are met and that their family feels a part of it. To whatever degree they're interested in having that be the case. Next slide, please, Jim. So one of the ways that we have donors come to us really often is in regards to family philanthropy and how to have your philanthropic giving be reflective of your values, both as an individual and as a family. And so, we see, I see my role as really a way to be a bridge between generations, to engage, not only the first generation of wealth providers, but, children, grandchildren, sometimes great-grandchildren all at one time. And as you can imagine, there are, a range of values and a huge spectrum of philanthropic goals. So, my job is really to help families achieve collective giving in a way that is reflective of the spectrum of goals. So we can help facilitate conversations that sometimes might be a little bit difficult, especially when philanthropy might be new, and help define what philanthropy means to the family across generations. We help create a family mission for philanthropy to really make sure that everyone understands and is sharing the same goals even if values might be different, even if what the issue areas that they care about might be different, as long as everyone is in understanding, it's really, really helpful for the philanthropy of the family to be really joyful. Next slide, please. In addition to creating those structures around the family and the family's giving and sort of the governance that we put in place around that, we also help include and integrate the family's advisor in this process when that's desired. As Jim alluded to earlier, the advisor is really a part of the whole entire holistic investment of the family's strategies, and philanthropy is one piece of that. And so we really like to make sure that we're involving the financial advisors as much as we can in terms of charitable planning. The advisor sometimes has access to the giving account and can help with planning activities and even recommending grants on behalf of the donor if that's something that the donor would want. And we also provide a service by which the advisor can oversee the investments in the charitable giving account, which is a really great way, again, to make sure that all investments are integrated at once. I just want to make sure that I touch on one or two other things that is a really great benefit to the donor advised fund and the way to achieve philanthropic goals. And that's, I think there's often a misconception that granting through donor advised funds is really simplistic, but we have the capability of creating some really much more complex capabilities in terms of working with the grantees to make sure that there's certain milestones, coming to agreements about, how to structure grants, putting in place multi-year grant recommendations so that, if you want to give $100,000 to one particular organization over a number of years, we can have those grant payments scheduled. So we really are able to facilitate much more complex grant making than just simple grants out the door. And we really pride ourselves in finding solutions that meet the needs of all of our donors.